before any eventual IPO of the retail business. So that's the big stock in focus. Let's in fact take a look at how Reliance Industries is doing this morning. The first tick on the opening bar is about 2% higher and making sure that the Nifty stays above the 19,370 mark. In fact, decent opening for the market. You have a 30-point opening on the index. The Sensex is up about 98 odd points and the mid-cap index is also trending in the green right now. The bank Nifty is sulking a tad bit, but nothing alarming really. Reliance is your top gainer, followed by Tata Motors. As we were telling you, that stock as well has been gaining quite a bit of ground and good wholesale numbers, 30% higher than what they did last year. Apart from that, Bajaj Auto, HDFC, Life, Britannia are topping the charts as well. So looking pretty good actually for the market now building on to its gains. Almost 60 points higher for the Nifty, inching towards that 19,400 mark. Sounds so strange, to say 19,400 and I was saying 18,000 for the longest time and suddenly you're like 1,000 points higher over there. But well, that's the market for you. A lot of auto stocks, right? Tata Motors, Hero, Eicher Motors, all in the green. Maruti Suzuki, many of them at new highs as well. So what is dragging the market? HCL Tech. And, Reema's been telling us that the numbers are not expected to be that good. So the stock market is sort of pricing that in. TCS ahead of its numbers is in the red. Tech Mahindra is also in the red. Infosys in the red. So, well, IT is having a bad start to trade. Divis Labs is also down about 1.5%, followed by Bharti Airtel, Bajaj Finance and Cipla that are not looking that good. But give and take everything, you'd have to say that, the market opening is solid and not bad. I was fearing that, there would be a bigger fall further after what we saw on Friday. But I think the market just took a bit of a breather and now are back on the running wicket. All right.
Sonia, Bajaj Auto, that stock is doing well. It's seeing a follow-through after last week's big move. So that's up close to around 1.5% or thereabouts. Eicher Motors, remember, it got slammed last week. It lost more than 10 lakh crore in terms of market capitalization. The stock was trading at around 25 times. It's come down to around 21 times its forward earnings. How much of the bad news is in the price? Time will tell. But that stock at least is stabilizing as we speak. From the broader markets, one stock that's flying away is Electra Green Tech. They won a massive order, a couple of sessions ago. And that stock is up close to around 10%. Volumes as well, absolutely huge. For the month itself, the stock is up close to around 38%. A few other notable movers. Max Ventures, there was some positive news flow that came in earlier. The stock is up close to around 5% as we speak. So that one's moved to the high point of the day. And from the frontline F&O names, JSW Energy, what a big re-rating actually that stock has had. It's up close to around 2.5% odd. They're adding capacity and they're doing it, also in the renewable space. So the street likes that. Stock is up 2.5%. GNFC is up close to around 1.5%. IOC is up close to around 1.5%. So good going out there. Balkrishna Industries on the flip side, that's down close to around 2%. And Vedanta for starters, well, it's as flat as can be. So no big reaction being seen on that stock. They're going to be getting both the semiconductor business as well as the glass business into the listed entity. But for the time being, that's as flat as can be. Hindustan Zinc, the stock ran up 10%, nearly around 9 to 10%. When they made that announcement, they're going to be considering an interim dividend. It seems the street wanted more. They declared a dividend of close to around 7 rupees. Remember, in terms of a float, there's only around 2% in the market. The remainder is locked between the promoter, the Government of India, as well as LIC. Stock down close to around 4%, giving back some of those gains that it put out in the past week. Reema, what else?
Well, the flyer in, the stock which is flying in the mid-cap space is Keystone Real Estate Developers. The stock is up 6.5% in trade. It's popularly known as Rustam J when it develops land parcels and builds buildings out here, at least in the Mumbai region. And the stock has gained 5.5% in trade. The company gave an update on their Q1 quarter and the sales have doubled on a year-on-year basis at more than 500 crore rupees, which compares with 240 crore rupees. So that's a stock which is gaining in trade. Max Ventures is also higher by nearly 4%. Here, the company has announced that its real estate arms, Max Estate, had launched its first luxury project in Noida. It was called Project 128 or some Estate 128. And it's seen pre-sales of 1,800 crore rupees. And I was just reading the pricing of this project was one of the most costliest ones in Noida. They were selling it at 18,000 rupees per square feet, the most expensive in Noida, and still it's garnered pre-sales of more than 1,800 crore rupees. IRB Infra is also higher in trade after the June quarter toll updates suggest a growth of 18%, and the management has indicated that they expect a similar momentum for the rest of the year. You've got Suzlon, which is also higher in trade after the board on Friday approved a fundraise of nearly 20,000 crore rupees. By the way, the mid-cap index has dipped into the red.
Just one more point. Reliance, their financial services arm is going to be de-merged. Will Bajaj Finance's valuations come under threat? For the time being, Reliance is up close to around 2%. But Bajaj Finance is down close to around 1% odd. Remember, it had a big run post its update that was declared close to around a week or so ago. But as we speak, that's moved to the low point of the day. So are those elevated valuations under threat? Because now you have another entity that maybe, in fact, could give them a bit of a run for its money.
And in other businesses, they've sort of monopolized the market, right?
Yeah.
In several businesses in just a span of 1 to 2 years. So the threat is that perhaps in this business, they could do the same. Absolutely. I just want to make one point on Olectra Green Tech. In March, when I spoke to the management, they had said to me that they're putting up a new plant in Hyderabad to manufacture e-trucks and buses. And they've acquired already 150 acres of land in Hyderabad. And this will be the biggest electric manufacturing facility in India. So, of course, since March, the stock has really rallied, perhaps anticipating all of this fresh demand that has come through and the new plant that's the company is going to be putting in as well. Just look at that spike up in just the last couple of months. But Kenneth Andrade, the founder and CEO at Old Bridge Capital Management, is joining us now to talk about the markets and how he's feeling about the big push that we've seen lately. Kenneth, hi, good morning. Thanks for joining in. It's been such a spectacular market, right? I mean, new highs and earnings have been picking up substantially. But what from here? Do you think this pace of growth is something that the market can sustain? And how are you approaching it now?
Okay. So we've come into a place that investors just had to remain invested, and you would have gotten a lot of capital gains on your books. Big question that Sonia you asked was what from here? Look, if you look at market cap to GDP, we are trending towards the higher end of the entire buffer zone, which is 1.1 time market cap to GDP. So we've been here before, but the follow-up of that hasn't been extremely good in terms of how markets have evolved over the next couple of years. So valuations are fair, but some part of the market has gotten reasonably expensive. So you've got to tread with a little bit of, I wouldn't say caution, but a large part of the valuation is already on the table. Incrementally, you'll have to be very narrow in terms of how you want to participate with the marketplace. And that cuts down to how financials have also played out. Now, when I talk about financials, I say corporate financials. It's difficult to find a company that makes a loss. Of course, there's a couple of them that are there, but in the NSE 500, about 15 companies make operating losses. Okay, and that also as a percentage is extremely low to where we've been historically. So we're going through a period, or rather India is going through a period where you're seeing the best of everything that is on the table. Margins are there at all-time high. Companies are doing extremely well in terms of cash flow. There is no debt on balance sheet, and valuations are representing all of it. Okay. So that's where we are. Incrementally, I'm not too sure that you'll maintain the pace of growth that the market has displayed till now, and you'll have to be a lot more selective in how you participate in the marketplace.
Kenneth, morning. Have you booked profits in any of your holding stocks? And if yes, could you give us an indication where you believe things have gotten a bit overheated?
So from a plain process point of view, just look at businesses that are all-time high in terms of margins, okay, and are trading significantly expensive to where they have historically been. I think that's a space that we are incrementally taking money off the table, right? So we haven't churned our portfolio for like the last 3 years, and a lot of those businesses have done reasonably well to extremely well. But anything that is trending over that 30-time multiple and also is gotten all-time high in terms of operating margins, I think we are a little circumspect of those businesses, and we are taking money off the table in some of that. But the challenge here is, and while that's one part of the answer, but the challenge here is the reinvestment risk that we are facing, because we will end up chasing something else. So we're not in a hurry to take money off the table. We'll just probably ride through this entire cycle into the next couple of years. Our portfolio churn should be about maximum of what 15 to 20% this year. I don't think it's going to be incrementally more.
All right. Hi, good morning, Kenneth. Thanks so much for joining in. Kenneth, I wanted to ask you about how you position on the IT space, because that's going to be the big theme that will play out, particularly for the next week or a couple of weeks at least. Are you looking to buy into it? Is it a contra trade for you? Or do you believe plenty of hurdles ahead, so you'd rather stay away and you'd rather be negative?
So the best way to capture, to build a portfolio is actually to try and capture it on the downside. Because what happens is you've got all the negative news, all of that is also reflecting in valuations. And because of the combination of two, okay, your downsides are limited. Now look, most of these companies are extremely mature. They're facing a global economy, and all the negativism that is sitting out there in the global economy is representing in where the valuations trade. Now, none of these companies are doing lower business in terms of volumes, right? So always looking at over the next 6, 8, probably the next 1 year is how and where do we participate in this segment of the marketplace. Now this is very representative of how investments in how the process works. Probably if I step back about a year or 2 years back, where we articulated our portfolios articulated the same on pharmaceuticals, and now you're seeing all the pricing power coming back, or some part of the pricing power coming back. Right? I think IT is going through the same format right now, and remember, this is a global business. This is not an India-facing business. Only India part of it is lower employee cost compared to the West. So I think that's essentially the positioning that we would want to take going into the remainder part of this year.
So you would be a contra buyer into IT?
It's not contra, really. You're just buying into bad news.
Buying into bad news. Got it. No, I meant contra because most of the street is a little bit skeptical on it, and you are looking at it a little positively. So you're looking to buy into the bad news. Got that, Kenneth.
Okay, well, that's always a good thing, right? I mean, buying into bad news and perhaps taking advantage of the fear in the market and going out there and being a bit greedy. That's always worked in the past. By the way, wanted to mention that the Nifty Auto Index has once again hit a record high. And so many auto stocks are at fresh record highs this morning, whether it's Tata Motors, Bajaj Auto and the whole lot. Of course, it's been a norm for a while, but these are fresh records. And something like a Bajaj Auto is up about 1.5%. But Kenneth, I wanted your thoughts on what's happening with Reliance and the Jio Financial demerger. Now we have the date out as well. You may not want to comment on the individual stock, but you know what's going to happen with Jio Financial Services is they are going to disrupt a lot of these spaces, right? Whether it's lending, wealth management, insurance, the payment finance, banking space as well. Do you think for companies like Bajaj Finance, now that a supposedly large competitor is going to come in, this could perhaps derail growth plans there? And what about the industry as a whole? How are you looking at it?
I'm not too sure it will derail any other participant because the marketplace itself is significantly large. And if you go on to address the bottom end of the population, I think that's a very broad the bottom pyramid of the population. That's a very broad and large category of borrowers to address. So no one's going to run out of the market. Now, it all is now left to execution. Now you've seen Bajaj Finance execute, or you've seen one company actually execute. You've got a number of other companies in the NBFC space who are also executing. But probably in terms of scale, in terms of growth, there's one company that leads the pack. The challenge in all of this is to find another participant that will grow. And if I had to relate it to anything else in the past and in history, given the fact that the marketplace is so large, okay, one private sector bank got established, the second private sector bank also got established, and then there was number 3 also that was there, and the number of companies that came through in private sector banking only expanded. I think the same thing is happening in every other industry that you will see, including NBFCs or financial services. So one company leads the pack, the second company will establish itself. I think over the next couple of years, you will see one dominate the other, or probably both of them split the market between themselves. So it's all about execution. It's too premature to talk about who's going to execute better and is someone going to lose market share, but I think the opportunity is reasonably large and scalable for everyone who's out there.
Kenneth, PSU banks have started seeing a lot of buying interest with names like, Bank of Baroda. The growth rates are also benefiting on account of the low base. But would you be positive on PSU banks at these levels?
So, Rima, if I just step back again, if you want a valuation trade, you'll always find one in the marketplace. Okay, and some part of the public sector businesses fall in that place. Some part of the IT businesses fall in that place. Are they the best businesses around? I think it's left to individual investors to decipher that as to how to play this entire category. Sure, there are a bank or two out there in the public sector space that offers a lot of value with reasonably good execution. But will they form a core part of our portfolio? I think we sidestep this entire space completely, and I don't think we're going to go down that path again. So it offers value. Some execution is great out there, and it will obviously make reasonable amount of money for over the next couple of years. But always remember, this is this sector of the economy, anything which is government-led or which is public sector enterprise, right, is always reflects the state of the economy. If the government's balance sheet is cleaned up, or if the government's balance sheet does well, public sector enterprises do well. Okay, and it works the reverse way also. So you're essentially playing a structure of improving financials on the government in the government, and the offshoot is these companies tend to do reasonably well in that format.
All right, Kenneth, final question before we let you go. If your markets are moving in your favor, you like to celebrate and open maybe a bottle of champagne and celebrate it. And if it's not going in your favor, maybe you drown your sorrows as well. I think you all had some exposure to the alcohol space, right? Global Spirits, if I'm not mistaken, and a couple of other names as well. How are you all positioned? Radico as well, if I remember correctly. How are you all positioned on that space? A lot of the good news is in, or do you continue to hold on to those positions?
So again, Nigel, it's been a phenomenal year or two for this industry. I think we've seen volume that we've never seen before again. And if I'm not mistaken, from all the statistics that have come out, India is the largest consumer of alcohol in the world. Right? I don't know if that's a good thing or a bad thing to talk about. But if you're at this position at this point in time, I think the marketplace is an opportunity to tear up in terms of pricing, which is what the market is all talking about, premiumization. So you've got the consumer in, you've got to make sure that they pay more for the same product. And if these companies execute well, I think the profitability could be very staggering over the next decade.
Okay, and you all have exposure in both these two names, Global Spirits as well as Radico? Just to confirm.
Yes, we're both.
Okay. All right, Kenneth, you heard Nigel say it, right? Whether you want to drown your sorrows or you want to celebrate the markets, the antidote is the same. All right.
Good or bad thing, we don't know, but it's reflecting well in the stock prices.
It's reflecting well. Okay, people are celebrating. Thanks a lot, Kenneth, for joining in. The market is celebrating as well, looking pretty good. Not giving up on any of its gains just yet. The only problem is in the mid-cap index, actually. The mid-cap index is now down almost about 100 points, but no great shakes, just sort of consolidating after what was a terrific run in the last many days. But let's move on. Let's get you some excerpts from an exclusive conversation. Earlier, Prashant caught up with the top leaders from the Shriram Group on the business growth opportunities for different entities going forward, and also discussed their overall vision for the coming year. Let's listen in to what they had to say.
The next big opportunity, or maybe the gap which is available, credit gap. See, ultimately, as an intermediary of financial product distribution, you look at where is the gap, credit gap, and go. Here, the credit gap I see in MSME lending.
Okay.
As per the IFC report 2 years back, around 32 lakh crore is the credit gap in the MSME lending. We are not getting into all MSME. We are getting into small businesses, maybe around 5 to 10 lakh ticket size, and merchant classes. We believe that's the big opportunity for us to get in. And we do have that product, but it was mostly focused in the south. we would like to take it to all India, because today with the merger, we have all India network with us. So with 3,000 branches, our ability to reach out and offer this product is much better. Recently, we also tied up with Paytm, so that the infrastructure built by them on digital is also being accessible to us. Because all these merchants who come into Paytm, onboarded into Paytm, they have a credit history there for 6 months, 1 year and all. Once there is a credit history, then we can have a credit rule engine, and then we can offer credit to them. That is something which we would like to do.
Talking about the insurance business, Mr. Gujral, on the general insurance side, the business is largely motor, right? 95% odd is motor.
Correct.
What's the plan? Do you plan to diversify into non-motor in a big way as well?
Starting the current year, it looks like that we will be hitting at around say 10%, which was around 5% over the last years. And in the next 3 years' time, the plan is that we should be taking it to around say 20%. And the 20% also will be more in terms of a larger GWP base. So it's 20% will be a worthwhile proposition. And the only reason we did not grow was a deliberate cause, because we thought that the pricing at which the industry was operating for the premium in the non-motor segment was not a viable premium. So now we have taken a conscious call. We have expanded the teams. We have brought in engineers to look at the risks very closely.
All the changes we are seeing from the regulator, we've got a very super active IRDA over the last 1.5, 2 years or so. I mean, does it mean a lot more competition in this space? Or do you think, it helps in accelerating the growth for companies?
Current chairman has actually been going very aggressive, very bullish in terms of expansion and the penetration piece. In fact, he is talking about the insurance companies growing at around say 40% and all. So I think there's a vision from his side. SGI on a standalone basis, the last quarter has been growing at around 40%. We were growing very fast earlier on also. I think one major important feature that we would like to highlight here is that when Ravi was talking about the capital requirement, we are currently at around 4.91, which is the highest in the solvency in the country as a whole.
Is there a listing coming soon?
Should hit, because KKR has made investment. They made an investment of around 9.99 and valued the enterprise at around 18,000 crores. So logically it should be on the card, but not in the very near future, but should take place in 3 to 5 years' time.
3 to 5, 3 or?
They would love to have it in 3.
Mr. Durvasan, on the chit side, sir, what's the plan? I mean, we were discussing earlier that is the, in a way, the fountainhead from where a lot of the other customer pool really comes from. Talk to us about that.
Shriram is making profit from day one. We even take Shriram City in Finance. So you have started doing very well in the Shriram City in Finance also. We did a two-wheeler business and SME loans and personal loans, gold loans. All these things we did very. You converted the children business to the finance business almost.
Other businesses.
Yeah.
Like where we're seeing with other businesses, external talent being brought in, etc. I mean, what's the thinking internally about leadership? I mean, getting the next set of leaders on board.
See, ours is a unique organization where the leadership actually comprises of the promoter at the trust level, because the ownership of Shriram Capital for the promoters is with Shriram Ownership Trust, and many of the key management are members of the trust, and that is how it has evolved, the structure. So when we are looking at the leadership which is required, obviously if we look at the numbers what we are indicating, we need a wide range of leadership across skill sets, and it is essential that we will need to look at both external and also see how we get the internal talent in place to reach that level. So we have a very structured methodology where both at the operating company level we have mechanisms to attract good talent and provide adequate stock options, etc., for them to evolve as good leaders. And also at the ownership trust level, it is a perpetual trust. So there will be a set of existing leaders, and we also continuously evaluate and induct leaders who can actually manage the future. And that is how it has evolved till now, and it is going to evolve in the future. So whatever we look at, we don't look at for the short term, but we need to have a structure in place which actually looks at the next 50, 100 years. And this trust mechanism where primarily the entire key management comprised of the members of the trust has been very effective.
So at operational levels, you get people from outside, but at At the very top, I mean, it's usually the idea is to group people internally, identify people internally?
Not necessarily. Because both the members of the trust actually comprise of both those who look at strategy across entities and also look at leadership at the operating entities level also.
Right.
So it is always a combination. And there is always a scheme where the people at the operating company level can also move to the trust level as part of the owner set. And because it needs a constant change as we move along as time progresses, and so the structure takes care of that.
Interesting conversation there with the top management of the Shriram Group. We'll keep getting you more updates and excerpts through the day. But let's talk about the weather. Torrential rains have wreaked havoc across North India over the weekend. Delhi on Sunday saw its highest rainfall in a single day in July since 1982. Schools have been given a holiday and the Met is predicting more showers today. Chandigarh's Municipal Commissioner IAS Anandita Mitra joins us for more. Ma'am, thank you very much for joining in. How are you all handling the situation there in North India? It's getting drenched in rain. Schools have been given a holiday. Are you sensing a lot of impact on the factories and industrial production too?
Thank you for having me. Yes, we've been facing unprecedented and torrential rains, more than 300 mm of rain in 24 hours. Next 5 days to see continuous and unprecedented rain. We are hanging in there. Chandigarh has also never seen an overflow of the Sukna Lake. But then the Chandigarh administration and the municipal corporation has come together and set up quick response teams. We are constantly addressing waterlogging issues, but not just waterlogging. We have huge issues of fallen trees because Chandigarh is also the city of trees. And in this kind of inclement weather, it's proving to be pretty difficult. But yes, we are hanging on.
Okay, do stay safe, Ms. Mitra. Thanks for giving us the updates. It's very unfortunate, especially to see those images of, floods wreaking havoc across the state. And we hear that the casualties are up to 18 so far across the North India district. What's the latest you're hearing on that in terms of casualties? And also just coming back to what my colleague was asking you, in terms of business, corporates, etc., getting impacted, what do you see as the situation so far? And how long will schools have to be shut as well?
Business, yes, because for obvious reasons, we have requested people not to venture out of their homes until and unless absolutely necessary. So definitely the retail business is being impacted. As far as the production units are concerned, Chandigarh doesn't have too many of them. And as on the industrial or the production units.
Okay, all right. We'll leave it at that. Thanks a lot for giving us an update and, hope the situation improves across the northern belt. Thanks, Ms. Mitra. Well, for the market, it's still holding on, actually, looking pretty good. So it's a 67-point gain that we're seeing on the index, not given up on any of its gains so far. We'll take a quick break. On the other side, Devin Choksi of KR Choksi Securities and Gurmeet Chadda, the partner and CIO at Complete Circle Consultants, will be joining in. There are lots of developments that have taken place within Reliance Industries, so we'll put the focus on that. And we'll also be joined by Probal Sen of ICICI Securities to discuss expectations from the oil and gas sector in Q1 in our special segment, Quarter Se Quarter Tak.
Welcome back. Well, the markets are holding at around 19,400 odd, but that's only courtesy Reliance Industries. Actually, stripped of that, the markets would have been in the red. Reliance Industries is up close to around 3.5% or thereabouts, and that's the reason why the Nifty is in the green. If not for that, we could probably be in the red. Just one more stock. Idea Forge, it saw a blockbuster listing. It doubled your money here, doubled your money on listing itself. Well, today it's pulling back a little bit. Idea Forge is down close to around 6%. As we speak, mainly valuations got a little bit stretched out, maybe too much euphoria into the stock, so it's pulling back a little bit this morning. Well, Devin Choksi of KR Choksi, as well as Gurmeet Chadda, Managing Partner and CIO at Complete Circle, joins us to discuss about the entity that will be demerged from Reliance Industries. It's a financial services company, and also what kind of impact it could have on other NBFCs. Good morning, gentlemen. Thanks so much for joining in. Well, Devin, you go first. Tell us, what kind of a value are you ascribing to it? It's going to have a lot of capital, so it will have the ammunition to grow from here on as well. What valuations would you give it?
Good morning, Nigel. Well, I think on the first place, I think this particular company, Geo Financial Services, assumes, I think, the capital of around somewhere around 1,50,000 crores, out of which I think about 1,10,000 crore would be the shares of Reliance Industries which they hold, and balance would be in form of their cash net worth that they have been having in the books. So typically, when you look at, I think, this kind of proposition, I think when you compare with the other largest peers in the industry, they are probably, I think, if not more, 2.5 times, 3 times more, I think, or more than 3 times rather, in my viewpoint. I think from Bajaj Finance could have about 45,000 crore worth of net worth, as against which I think here you are having net worth, actual net worth in excess of around 1,50,000 crores. But even if I had to take the haircut of the shares, it is around 3 times. So from that perspective, I think you're likely to see the sharp jump into the business going forward because of the net worth that they have. On the other side, the business proposition is that you have the merchant lending business on one side and the retail lending on the other side. As far as retail lending business goes, I think the electronics segment of the business could be, I think, the prime driver of the higher amount of credit offtake is concerned on subvention pricing, which this company could take an advantage of in form of getting higher amount of NIM. On the other side, the merchant lending, because of the presence with the Kirana stores, they would probably have this ready to consume credits as far as the market is concerned for them, which could also drive the business for them for the retail business. So in my viewpoint, I think as far as Geo Financial Services is concerned, this is going to be, I think, accretive for the shareholders of Reliance Industries from the day one, because in a 1:1 ratio, the shares are being allotted. And that is where probably I think you are likely to see higher amount of growth into the stock price. I haven't calculated, I think, per share impact immediately as far as I think what exactly would be the impact. But we believe that I think 3 years from now, the business of Geo Financial Services could have assumed the book size of around 10 lakh crores. So that is where we believe that I think the higher valuation would ultimately be available to shareholders of Reliance from Geo Financial Services eventually.
Okay, so 10 lakh crores is what the book of Geo Financial Services could be. You're saying 3 years from now, the total business and how much it's valued, right? In fact, I wanted to get Gurmeet into this discussion as well. Gurmeet, when we were chatting earlier, you said to me that, Geo Financial Services, once it comes through, once the listing happens, is going to disrupt a lot of spaces in a big way, whether it's lending, wealth management, insurance, payments bank, etc. How much of all of that you think is already in the price of Reliance Industries?
Not much, Sonia. I think it just moved up 3-4% today, and it's been in a range, that 2,200 to 2,700 range now for almost a couple of years. So I think I agree with Devin sir that if you see at 6.1% stake at today's market cap is about 1.1 lakh crores roughly, and you add the other, if you add the combined net worth and divide it by the number of shares, the book value would be close to 200 odd. Huge excess. So, you have Geo at 44 crore subscribers. They clearly have a sense of how much is postpaid, prepaid, what is the pattern. Then you have, Reliance Retail at 18,000 stores, and they're leader in a lot of categories, including groceries, lifestyle, electronics, as Devin said. Also, RIL or entire vendor system, they exactly know, it's a huge vendor ecosystem RIL has across various businesses. And the best part would be that they will get a AAA rating, courtesy the AAA rating of RIL. So the cost of borrowing would be in lines with some amongst the best. In fact, would be lower even than Bajaj Finance, etc. So if you have a cost of borrowing lower and you have a huge network client base, good data analytics other than your traditional credit-based, bureau underwriting, I think this could be, and they've made a mention of that they want to list the consumer businesses eventually. So I think a lot of future value unlocking is in store. What you're just seeing right now is probably a beginning.
Yes, Reliance can leverage the entire network effect of Reliance Jio as well as Reliance Retail, and one should also watch out for attrition at the other NBFC or payment companies, because as Reliance Jio looks to build this company into a behemoth, it will be looking for talent, and the talent could come in from the existing players. Deven, I know it's very early days and a lot depends on Jio Financial's execution, but would you be cautious on any of the lending franchisees in the NBFC space, the likes of, say, a Chola or a Bajaj Finance? Is it time to, just, take a step back from investing in these companies to see how this entire battle plays out and competition heats up?
Well, actually speaking, I'm not too much concerned about how exactly it is going to play out for the competitors for a season. Because on one side, the credit growth is systematically growing for all the players. It's not that I think for only few players it is growing. On the other side, every other player has a book size, which is, I think, limited to whatever they can lend. So from a perspective of looking at higher amount of ability to lend, and if Reliance Jio Financial Services entering into this particular market, somewhere they are also going to convert the unorganized market, I think, into an organized market through a systematic use of the platform-based disbursals of the credits. And that's where probably I believe that they will have a larger opportunity at the same time. Say, for example, today Kirana stores. Kirana stores, as known, I think they also resort to a significant amount of unorganized sector of lending. Now, if these Kirana stores are linked to the entire Geo platform solution, then the credits goes naturally to these Kirana stores, and that market is absolutely untapped at this point of time by most of the players, which could possibly, I think, become a real market for them. Similarly, on the other side, I think likes of Bajaj Finance has successfully created a model wherein I think they produce zero EMI based customers in different verticals. Now, given the size of Bajaj Finance, I guess I think if you have larger amount of balance sheet available elsewhere, then probably I think the customer is on the other side who is consuming more, and that could create another set of market. And that is where again I believe that Geo Financial Services could play a role. Yes, I think the threat remains to those players who are unable to process loans in time at the instance itself. If they cannot process it by use of the technology, certainly I think they would be relatively at disadvantage. But I think that fraction of people are relatively small, and the size of their balance sheet is also small. Like for Bajaj Finance, I believe that I think they are very well and adequately placed, even with the technology that they are having at the front end. I would not be unduly perturbed about the entry of Geo Financial at this point of time. And as I said, 3 years are required for any financial company to build the model minimum. And that's where I guess I think the Reliance Jio Financial will have to, I think, demonstrate in next 3 years how exactly they'll successfully make inroads into different markets.
Okay, all right, Deven, taking note of that point. Gurmeet, what about you? Bajaj Finance, you have been fairly positive on the stock and it's worked very, very well. On a price to book basis, well, it's at, I think, it's one of the most expensive stocks, but maybe for good reason. Given that the stock is under pressure, would you look to get into it? Or do you believe now with the entry of a big formidable player, there's a risk to that price to book multiple itself?
Nigel, I agree, not immediately, but there will be eventually a risk because Jio, if you see disrupted mobility, so some margin pressure could come in as they disrupt, and Reliance is known for scale. So it will not happen immediately, as you know, even Devin said, it will take time, and NBFCs take time to really build scale. But at Reliance level, the scale will be built much higher. And I think a lot of these new age businesses, you need to now value on basis they're earning multiple more along with the price book, because they're basically a play on consumer spending in India picking up, more largely discretionary. Second, credit creation. You know, the 40, 50 crore customers now coming in the formal credit did not have access. So there is space for everyone. There's a space for credit access, Grameen, Equitas also. There's a space for, the digital lenders, including Bajaj Finance or even Paytm right now. And there is space for, large. We probably need more Bajaj Finance and Jio Financials and HDFC as we embark on that journey, right? Because the overall market is large. But I think the big story to me is the value unlocking in RIL. I think if you value even retail, if you take both the developments together, RIL now is valued at almost $100 billion with just 13% contribution to EBIT. Jio Financial Services will get demerged. Eventually, Jio also will get. So technically, at current valuation, oil to chemical business is virtually free if you just evaluate, just the valuation. So I think now it's a beginning of, as they've made points that consumer business is getting listed separately over next 12 to 24 months, and a lot of value unlocking happening.
Okay, I guess the comparison with Bajaj Finance and GFS is valid, right? I mean, if you look at just the numbers, Bajaj Finance's consolidated net worth stands at what, $7 billion right now. And GFS, after it's infused with 6% of Reliance Industries treasury shares, implies a net worth of $13 billion. So straight off the back, it starts off as being the largest NBFC in India in terms of net worth. So I guess that's why Nigel's question to you on Bajaj Finance and the comparison there, and whether it's a big threat. But thanks, gentlemen, for joining in. Appreciate your thoughts. We'll, of course, continue this discussion, this evaluation on all the latest takeaways from Reliance Industries through the course of the day. So stay tuned. But let's get to our special segment now, Quarter Se Quarter Tak. Sonal is here today to take us through what you can expect from the oil and gas sector in this quarter. Sonal, over to you.
Thanks for that, guys. Well, oil and gas stocks, they have been very excited ahead of numbers, and it is expected to be a decent quarter, at least for some of the segments here as well. First, the macros. Brent crude prices continue to be lower, 31% down on a YOY basis, 3% on a sequential basis. This is at $78 a barrel. Even Singapore GRMs, they were lower. Big decline here, down 51% on a sequential basis. This is due to decline in cracks across most of the products. And that's why we'll see a decline in refining EBITDA for Reliance Industries, and that will impact numbers this time. Overall, Reliance's EBITDA is expected to decline 2% on a sequential basis and 1% on a YOY basis. However, the weakness in refining will be offset by strength in Jio and retail. For upstream companies now, like ONGC and Oil India, EBITDA will decline on a quarter-on-quarter basis by 8% on a sequential basis. It is on an average driven by lower gas prices because government had capped domestic gas prices at $6.50 per barrel versus 8.7 earlier. And also, as I said earlier, lower crude oil realizations will impact earnings. But star performers this quarter will be the oil marketing companies. Strength will be driven by their marketing segment, where over recoveries will be reported by all these companies. Weakness in refining segment will be seen, but that will be offset by marketing, where petrol and diesel margins are anywhere between 8 to 9 rupees per litre. GRMs are expected between $7 to $9.9 per barrel, which is a sequential decline overall. However, EBITDA and PAT is expected to improve for all OMCs, both on a YOY and on a quarter-on-quarter basis. Now, for CGDs as well, like IGL, MGL, it will be a good quarter due to lower domestic gas costs, and for Gujarat Gas due to lower spot LNG prices. Margins and volumes are expected to recover, and 19% EBITDA and 25% profit jump is expected here. On to gas utilities, because they will also see good quarter on a quarter-on-quarter basis. For GAIL, quarter 4 was very weak due to one-offs, and hence quarter-on-quarter EBITDA is expected to go up by 10 times. For Petronet LNG, high Dahej utilization and high Kochi tariffs will also aid earnings, and lower spot LNG prices will improve earnings for the gas utility space, which includes GSPL as well. Now on to valuations. Reliance trades at 23.6 times and the PSUs continue to trade at lower valuations. ONGC at 5 times, you have IOC, BPCL and HPCL anywhere between 3 to 4 times. City gas companies between 12 to 22 times, where MGL is the cheapest in the space.
Okay, thank you very much for that. Probal Sen, the energy analyst at ICICI Securities, is now with us on the show. Probal, morning. Thank you very much for joining in. Let me start with the oil marketing companies. That's where the most recent bullishness is. They are expected to report very strong GRMs, as Sonal was telling us. And in the comparable quarter of last year, the GRMs were negative. So oil marketing companies are going to have some elevated earnings this time. Would you be bullish on the stocks at these levels? Or has the street priced in all the good news?
No, I think, we have been bullish and we have been fairly positive on the OMC space for the last month and a half or so, from the time that the marketing margins really started to ramp up and FY24 prospects became a little bit clearer. Our sense really is that there's as Sonal was mentioning, there's a very big swing. I think if you look at operating profits, almost a 50,000 crore swing from a loss of around 15,000 odd crore last quarter to more than 30,000 crore in aggregate of EBITDA from the OMCs this quarter. And this is despite the fact that there has been a $4 decline QOQ in GRMs. If we look at Singapore, not all of that flows through to Indian players because the product slate is different and we have some Russian crude benefit and all of that. But as a trend, GRMs are down, but the marketing margin benefit continues to be very, very strong. Our sense is that FY24 is likely to be an extremely strong quarter as far as earnings is concerned for the OMCs as a pack. Even if one assumes that at a certain point of time this year, some pass-through of this marketing margin benefit may happen for petrol and diesel. Despite that, I think the street estimates are bound to be upgraded, I think, by about 15 to 18%. That would be my sense. And to that extent, even if valuation multiples don't see a huge upgrade, just the earnings upgrades will actually ensure that there's very, very strong returns from the OMCs in FY24.
Okay, by the way, we just need to pause a little bit. That's a fabulous listing that we're seeing from Cyient DLM. And, Rima was mentioning that earlier as well. It's listed at 403 rupees a share. That's more than a 50% premium to its issue price, which was 265. So that's a very smiling, happy team as well at the, listing venue. We just saw images of that. But Prabal, very quickly on Reliance Industries, what do you think the SOTP value could be now? There's lots of developments that have taken place, especially on GFS. The demerger date has been announced. Also on what's happening with Reliance Retail. Overall, what's your sense? Do you see more upsides here?
I think that frankly, we'll have to sort of, get a little bit more understanding of the valuation of the financial services space. Retail, I think, given the valuations that have come out, are broadly, there or thereabouts in terms of where the street was valuing the retail business. Obviously, as and when, a listing announcement happens in due course, we'll have to understand how that happens. But as far as financial services is concerned, right now, to actually put a value base, particularly me, I would leave it to our financial services team to sort of give an opinion on the business as and when we gain more understanding of what all will be housed in this segment. On an overall basis, frankly, we have had a fair value of somewhere around 2,700 to 2,750 for the stock. I don't think that we would be changing that materially at this point of time.
You said 2,750 to 3,000 is the target price on Reliance, right?
No, I said my fair value is around 2,700. I think the street is in that range.
2,700.
Between 2,600 and, yeah.
Okay, and in that, what is the value that you've ascribed to retail and financial? I missed those numbers.
To retail, I think we have around somewhere around 700 to 800 rupees a share. Financial, we're not valuing it too much at this point in time.
All right, Prabal, what about the city gas distribution companies? How do you approach them from here on? Gas prices have cooled off, volumes could pick up as well. And now they're coming back into flavor after, those duties that have been introduced on propane. So your view on the stocks?
Well, I think firstly, as far as the cost environment is concerned, definitely the $2 reduction in domestic prices as well as the kind of softness we're seeing in spot LNG prices is something that will continue, to sort of make, drive margins higher over the next year or so. More importantly, the price competitiveness with petrol and diesel, which now stands at 50%, I think is a major driver for, volume growth that we would expect over the next 12 to 18 months. As far as propane's duty is concerned, I think it probably provides a slight short-term benefit, for maybe a month and a half to Gujarat Gas. But if you really look at the way that propane prices are actually behaving, one suspects that Gujarat Gas will probably need to cut prices even more to sort of remain competitive. Because the propane price reduction from $450 to $400 means that even with the duties built in, the comparable price for propane in Morbi is likely to be around 33, 34 rupees, whereas Gujarat Gas's retail price is still at about 38.5. So I would say that there's a little bit of pain still ahead in the near term for Gujarat Gas. But for IGL and MGL, I think the metrics look substantially better. And even if you were to build in a price decrease in petrol and diesel, as I mentioned earlier, by the second half of the year, even then the differential for CNG versus alternate fuels remains well above 35, 36%, which historically has been a comfortable level to drive, strong volume growth for both companies. So we'll be very, very bullish on both names at these levels.
Okay, and on Gujarat Gas, you're seeing a little pain. Actually, the street is also pricing it in. I mean, if you pull up the Gujarat Gas chart, it hasn't performed as well as the market has in the last 6 months. It's been sort of, lackluster, perhaps factoring in that pain that you were talking about. I also wanted your thoughts on gas utility companies, whether it is GAIL, GSPL. You do mention that there are two factors which are aiding them, right? Stronger gas demand, and now a lot of the supply side issues have eased as well. Does this portend higher, bigger upsides for some of these names?
Well, I think there are, frankly, clubbing them together is a bit tricky. I think separate factors are playing out for each of the names. For GAIL, I think the critical monitorable will be when does the impact of that 9 MMSCMD of Gazprom's disrupted volumes completely fade away. Our understanding was that after the formation of a new entity, which Gazprom had done in Singapore, and transferred the rights of the contract to that new entity, the gas supplies have resumed to a certain extent. So if that gas supply is actually resumed completely, then that is a big change from what really hurt them in FY23, specifically in the petrochemical and LPG segment, where they had to sort of obviously allocate different sources of gas, so the costs went up quite a bit. Secondly, as far as trading business is concerned, what kind of profitability trends are seen, and as you rightly mentioned, demand for gas at these low prices should rightly go up. Petronet LNG should definitely benefit from the kind of softness we're seeing in short-term and spot LNG prices. Their third-party regasification volumes have really been very muted over FY23, so one would expect some pickup there. Having said that, I think the prospects of the petrochemical expansion are something that we are not very sure about in terms of, that's 4 years of operating cash flows that will be spent on the petrochemical expansion. So we have to understand the economics of that project a bit better. Otherwise, at least in profitability terms, the business should do better. GSPL, I think, is going to be a function of the tariff order and, how the sort of gas demand shapes up. Plus, it also has to contend with Gujarat Gas's valuation, which always is a big component of its overall value. So, as and when we see Gujarat Gas's prospects improving, that would be the next trigger, particularly at these price levels for the company.
Probal, we'll leave the discussion here today. Thank you very much for joining in. Need to get into a very short break with the news. The Nifty just shy of the 19,400 mark, holding up in the green with a gain of about 0.3%. IT is dragging its feet. The Nifty IT index is down 1.2%, with heavyweights like HCL Tech lower by 2.5%. Mid-cap IT is selling off Birlasoft, LTI Mindtree, L&T Technologies, Service, First Source. These are all stocks down 1.5% to 2% this morning. On the other side of the break, Mitesh Thakkar will be with us for a few technical trades. Stay tuned. Welcome back. 19,400 on the Nifty, 68 points higher, and all of that is courtesy Reliance Industries, and it's 10.5% weightage on the Nifty. Pull up the contribution plate and you would see Reliance Industries is currently contributing 78 points to the Nifty up move. Stripped of that, the Nifty would have been mildly lower. Mitesh Thakkar is with us on the show now. Mitesh, any 10 a.m. trades, and what have you made of the day so far, the morning?
So, good morning. No trades on the Nifty per se, but you rightly said, Reliance is the key contributor. I would want to buy that in case I get it slightly lower, let's say about 20 odd points lower. But for the timing, I have one buy and one sell. You can look at the charts of Hindalco. I think that's picking out very nicely. So, Hindalco is a buy with a stop at 425 for a target of 442. And mid-cap IT, I think, was being highlighted as a sector which is seeing some pressure. So, I have a sell there on Coforge with a stop just above 47005. I would look to sell this for targets of around 45.60.
All right, thanks a lot for that. So a lot of the IT stocks are under a bit of pressure just in the run-up to the IT earnings. But let's track some more stocks now. ICICI Pru Life is a stock on our radar. Surabhi is joining in to give us the latest on that. Surabhi, over to you.
Thanks for that. So ICICI Pru has come out with their June 2023 APE numbers as well as the Q1 FY24 update. For individual APE for month of June, they saw a growth of 12% and the total APE grew by 11%. The ICICI Bank channel APE declined by 14% on a year-on-year basis, but it was still lower than the last 2 months decline. The other channels APE saw a growth of 17%. For Q1 FY24, both total APE and individual APE was down 4% on a year-on-year basis, but the new business sum assured was up 9%. Now, that indicates that the overall protection business could have done well, but we'll have to wait for the data from the Life Insurance Council for retail protection, and that will put some more perspective on the numbers.
Okay, thank you very much for that. Get into a break then. On the other side is our special segment. It's the economy, where Lata will get chatting with Sunil Kaul, Asia Pacific equity strategist at Goldman Sachs, about their India strategy.
Welcome back. Goldman Sachs has put out an equity note saying that they see the Nifty at 20,700 over the next 12 months. Now, this may disappoint some who see 20,000, much earlier, going by the pace of the move since the Nifty conquered 19,000 on June 28. We managed 400 points since then in just about 7 trading sessions. But Goldman says India is the best growth story in town. Then why are they somewhat modest about their Nifty expectations? To answer that, joining me now is the author of the latest equity report, Sunil Kaul, Equity Portfolio Strategist, Asia Pacific for Goldman Sachs. Sunil, good morning. Thank you very much indeed for joining us. You know, the pace, again, with which the Nifty has moved in this quarter, April, May, June quarter, gives the sense that, 20,000 can come pretty quickly. You don't share that kind of enthusiasm?
Lata, thanks for the invitation first. I mean, as you said, we do have a target of 20,700 on Nifty on a 12-month basis. So we do like India structurally. But I think given, as you said, the last 3-4 months, the pace of recovery, not just in the Nifty stocks, but also within the broader market in mid or small caps, it does feel like both in terms of valuations with the market trading at 22 times, but also in terms of some of the risk appetite indicators we are tracking, we do think that markets may need to kind of consolidate here in the near term for the next sort of 3 months or so. I think as you get closer to the fourth quarter, heading into the festive season, with the third quarter earnings coming through at that point, maybe the market kind of regains a bit of momentum. But for now, we think for this quarter at least, we're probably looking for markets to consolidate from current levels.
Okay, fair enough. Yes, markets have run hard. But, you have a very interesting table in your page 13 of your report, where you point out that every time the market has been over 19 times, in the next 6 months and 1 year, the returns have been 2%, 4%, and that's the average. But you also give us another table where you show the excessive returns it has given. I mean, it has run hard and continued to run hard as well on certain occasions. You don't think this could be one of them, considering the excitement about the India story?
Look, I mean, as I said, we are pretty excited about the structural prospects for India. I mean, we do think there's a lot of stock picking to do in terms of alpha. I mean, we actually had a report out a month or so back where we actually showed that India has been the most fertile ground for picking stocks in terms of alpha picking. And we actually compared 10 different markets, 7,000 odd stocks, and India has the highest proportion of multi-baggers, meaning the stocks that have given you more than 10x returns over a 5-year period in the last two decades. So I think there is a lot of bottom stock picking opportunities there. I think having said that, as I said, earnings are still growing at 15% plus compound. So we are expecting earnings to grow 17% this year, another 15% next year. So with that kind of mid-teen earnings growth story, we do think markets go higher. But I think at these levels, as you also noted, valuations at 22 times is expensive. Historically, as you said, from current levels, return tend to be moderate, which is why we have 7-8% upside in local currency terms, 10% in round numbers in dollar terms, total returns for the market, which we think is kind of fair. I think we also have to keep in mind where the macros are. So with the global growth generally kind of slowing, the rates probably higher for longer. We do think 19 times is probably fair for India at these levels. So we do bake in a bit of multiple compression in our numbers. So the way we sort of get our return forecast is that you have a 15% earnings slope, and then you get a bit of sort of 5% plus multiple compression, which is how we get to that return. I would also point out in terms of valuations that the starting level of valuations right now for the market is the highest it has been in a pre-election year. Going back for the last 20 years or so. So you also have to keep that in mind. So again, as I said, I think we like India longer term story, but at current levels, we think the returns are more likely to be moderate.
Oh, yeah. No, the pre-election thing is important. I take your point on that. After the Karnataka elections, that seemed a worry. After the Maharashtra happenings, it seems like it is pretty much in the bag, and election is hardly a threat, but perhaps a positive. But that discussion closer to time, not now. Sunil, before I get into your specific sector preferences, I wanted to ask you about the global scenario. Last week we had like huge data on private payrolls. I mean, almost 450,000 jobs when the expectations were about half that. Of course, it was cooled by the payrolls, the jobs data, which was a tad lower. But there again, the hourly wages, all that is still very strong. are you all worried that we could see more tightening than the world is prepared for, and that can be a headwind in 24 or late 23?
Yeah, that's a great question, actually, Lata. Look, I think if you look at the macro, if you step back a little bit, there have been sort of shifts on the growth side. There have been shifts on the rate side, as you mentioned. So on the growth front, it does feel like, when you look globally, it does feel like obviously China growth has faltered a little bit. And on the contrary, US growth is holding up pretty strong. And as you probably know, we have an above consensus, or have had an above consensus view on US growth. We still don't have recession in our forecast. We only have a 25% probability of US recession, whereas the street is at 60%. So we have been sort of optimistic on US economy, and it seems like that story has gone a little bit even better. Which means, I think, when you look at India, the fact that for the region overall, you've got China growth, which is slowing, but US sort of holding up pretty well. So the markets in the region, which are kind of more China sensitive, probably have more downside risk to earnings, whereas I think the markets which are more sort of sensitive to US growth probably have some upside risk. So I think India, therefore, is in the right zone, wherein we're not as worried on the growth outlook, because domestic growth looks still strong, but on the other side, I think US growth, which India is kind of exposed to through its equity markets, is helping India. But I would say I think the risks are more on the tightening side, as you said. So we do think there is one more rate hike in terms of Fed. So in July, later this month, and then Fed is on hold. But given the hawkish commentary from the Fed recently, as well as the dot plots, it does feel like there's a risk that they may actually go for another hike later in November, although that's not our base case. I think RBI, on a similar note, has been sort of sounding hawkish as well. So I would say on the margin, it does feel like you could have renewed sort of tightening risk. And if you look at the markets last 2-3 months, I think the sectors that have been more sort of benefiting from lower rates have done well. And so to the extent that if the market starts to price out any rate cuts next year, but also kind of rates higher for longer, I think that is a headwind for equity markets. We also have to keep in mind, I think, as the market kind of prices out any rate cuts, you will also see dollar continuing to be somewhat stronger, at least relative to the Asian peers, and that typically isn't a great environment for flow. So you put all of that together, it does feel like globally it could be kind of a bit of headwinds, as you put it, for the global equities in general.
Okay. Yeah, though you do point out that while the dollar strength may have some impact on capital flows, it's not a current account deficit problem, since there things are way more benign for India. Now let me ask you to talk sectors, because that's what our viewers want. Once again, more of banks is what your list is saying. I mean, any preferences within the banks? I mean, would you go for public sector banks now? A few of them have shown remarkable growth.
Yeah, look, I mean, if you look at the last 2-3 months, actually, the sectors that have done very well is real estate, autos, some of the NBFCs. All of those actually benefit from potentially lower rates, as I said. I think banks actually have actually lagged in the last 3 months or so. Okay. So you're looking at a sector where they are still trading at sort of mid-cycle valuations, or valuations are not expensive. There is a decent kind of visibility on growth, sort of high teens earnings growth at decent valuations. They are still gaining market share from the NBFCs. In fact, if you look at the banks versus NBFCs trade, I think the fact that NBFCs have rallied in the last 3 months pretty hard, and the valuation gap has reduced between NBFCs and banks, that on the margin continues to for us to favor banks over NBFCs. So we think that's an area people will continue to prefer, especially given the fact that I think in this environment, if the market kind of consolidates, you probably want areas which have significant or decent visibility on growth. I think banks kind of check that box. As I said, I think within banks, we would prefer banks over non-banks or NBFCs. We would like private banks as well as some of the largest PSU bank also in there. I think it's the private banks and the largest PSUs which we like. Okay. Given the stability of earnings, which is an important criteria, we would kind of stick to that list in the near term.
Okay, you very
stage where we think there are any near-term asset quality risk, but I think it's an area which we need to be watchful for, and valuations aren't particularly cheap in that area. So in general, as I said, banks or NBFCs, and within NBFCs, if there are higher quality NBFCs, which are more into kind of B2B or kind of industrial segment, we like them more as compared to ones which are more in consumer-oriented sectors.
Well, I spoke about NBFCs also because today we have this announcement of Reliance taking one more step, perhaps, to list their retail venture. And that set the market thinking, which means the finance venture also will not be far behind. Will that mean more trouble for consumer NBFCs? Is that something that went into your thinking at all?
Not really. I think within the banking sector, I think the way we're sort of thinking about it, I think when you speak to clients, I think people are in the camp wherein they are saying, look, I mean, you can obviously get a little bit more upside in some of these names, but you have better comfort in terms of earnings visibility with banks, and they are not expensive. And so if you have that comfort, why sort of get into a segment which is somewhat more riskier and trading at higher valuations? So I think from a relative risk reward, therefore, we like banks over the NBFCs. That's what sort of was the main thought. And as I said, within the NBFCs, if you're more into sort of credit, consumer credit, credit cards, sort of personal loans, sort of housing finance, we sort of are a little bit more cautious on that space. So which is what keeps us underweight on the broader consumer NBFCs.
Well, okay, actually, it's an extremely rich report where Sunil is pointing out to laggards who have not done so well, like, the HDFC Bank, the Kotaks, even Reliance Industries. And then there is a list called, stable growth guys, like, again, HDFC Bank, Kotak, Larsen. So it's an extremely rich report. But just one final question. I'm out of time. Sunil, what about the newbies? The Nykas, Zomatos, are they also something you would chase now?
Look, I think the risk reward on some of those names is improved. We're sort of more market weight that space. I think valuations have come down. The focus on profitability is there. I think with some concern about renewed sort of rate risks, we are somewhat still more measured in there.
Okay.
And again, I think there is a little bit difference in terms of different subsectors. But in general, I would say the places where we see the most upside right now would be banks, as I mentioned, but also I think the broader rural recovery is a theme which we didn't sort of speak about, but that's something we have been sort of also flagging, because that's an area which has been lagging in the last 2-3 years. We think there you could get more upside. So we're not sort of underweight or cautious on the new economy stocks, but we think risk reward still is better in some of the other pockets of the market. So we are kind of more market weight that area.
Okay. Out of time, but it's an extremely interesting report, Sunil. Thank you very much indeed for joining us and giving us a peep into the important takeaways from that report. 20,712 months. A couple of risks that Sunil points out to, El Nino and elections. Both seem now strengths, actually. The monsoon deficit is wiped out and elections don't seem the scare they seemed a couple of months back. So probably with some luck, Nifty will do much better than the 20,700. But that's a good number anyways. Wrap up on Bazaar. Chart Past is up.